Okay, so let's get started with the case study. So this is the fourth and final week. Like we've been saying, this will be the probably the most exciting of the weeks, just because we can start to put everything together and start to see some real results and from what we previously tested or the data that has been collected can then actually turn into something that's usable in the trading market. So case study week 4 is all about looking at indicators. So we talked about right back at week 1 looking at some automatic discretional indicators, meaning we want to have something that's applied quite automatically. So we don't want too much discretion as to when you don't use it, but at the same time we want to keep these indicators quite dynamic, so they sort of move along as the market moves. We just don't want to sort of sit still and just take it, just quite a bland system. We need quite dynamic parts coming into it, because a static system will, it'll work at times, but you're going to come into trouble. So the goal was to take this information, keep it very automatic, but with some real some dynamic parts that are certainly thrown in there as well. So that's what we'll do. We'll go through the data just quickly again and just see that even just as a basis of the data, you can see a few things start to pop up and working. And we'll take sort of the better couple of systems or couple of areas that worked as far as the raw data is concerned, and then you'll see it has a bit some flaws, but then we can add a few things, and that's where we'll look at some indicators that I've created and add them in and see how that changes the dynamics of the data. And what it's all about is looking at what we previously talked about in risk models. Some of the things that are really going to focus on as far as getting some better results from this data is, one, expectancy of the system or return on investment. So what's your average gain per trade? Just looking at everything on average gain times by frequency, because obviously the number of times that trade comes up really matters as well. So you'll see some real different systems here, and some of them are high in this areas and low in other areas, and you can sort of start to really mix and match and create a system that suits your requirements. But we'll look at expectancy, frequency, and drawdown also. So drawdown is a big part. Like drawdown, you've heard me speak a bit about drawdown, but drawdown is something that I focus on most with systems. Yeah, that's the way I trade. That's the way my objectives are set, and I really want to focus on keeping my drawdown levels very low, and I want to keep a fairly smooth equity curve. But we'll look at those things and how they affect all the different systems that we create. And all up, there's about 9 different sort of systems to look at. They're all slight different versions of each other. So if you remember from last week, just going over it again, just so we can quickly understand why we're looking at what data we do look at tonight, and that's, I'm going to focus on the power points and the second terminator. So remember, we got the first power fade up here, so you can see over here it got quite a hiding. So here's the overall results. There's certainly something there to be used as far as taking it in the opposite direction, but as far as the first power fade and doing anything with the first power fade, it's quite tough. There was one particular area of the power fade we'll talk about later on that I looked at, but even anything I really looked at with the first power fade, in the end, when you did over a longer period of time, just proved to be not really suited to this market, not really suited the way that I was trying to make it work anyway. So that's the first power fade. We'll be leaving it alone, that's for sure. First power point, of all the areas, this one worked the best. When you look at sort of why this area worked the best, it seems that if the market was going to trend, quite often it would come down and bounce. Even if the market wanted to just do a sort of go straight through the power point, often it would just bounce and get sort of 8 ticks from it. But just time and time again, the strike rate on this particular area, the first power point, was very high. And you can see here strike rates is down the side of all the areas, around 34 to 47%. So quite a high strike rate there. Next one, first terminator. So that's quite similar to the first power fade, and you can see it's worked quite well. I mean, virtually it's the opposite of the first power fade. But it's just a bit of another version of the PowerPoint, so we won't so much focus on that. We'll focus on the first PowerPoint. And then we get into these other two. So once we've got the first PowerPoint hit, and basically the market gets a bit of time to pick up a trend or do something, we want to look at sort of the next phase of the market. So these two are a completely different area of the market. Those other three, we're just really looking at what's the first movement of the market. once it has an opportunity to do that, what's happening then? So that's why I want to kind of keep it with two layers of entries, so to speak. So this is the second area. I think both of these, if you look at it over longer term, they'll do all right. Of the two, the power fade, the second power fade, interesting enough, is the one that sort of showed some promise towards the back end as far as some trailing stops and some bigger stops. And then the second Terminator, overall it was, had some alright areas and had some areas that weren't so good, but consistency wise, there wasn't a lot there unless you actually start incorporating it with the second power fade and sort of do a blend that way. But that's the overall data again, just quickly going over that. So what we're going to focus on, let me bring it up here, find the spreadsheet. Okay, so just to let the projection catch up. So this is where I wanted to start. I'll go through this here. So this is some systems that we put together from the data, but before we do that, just a few of the goals or objectives and a few of the things that were used for the basis of creating these systems. So what we've got here, and we're going to go through them, is basically some proven systems. So there was many different combinations I did. There was probably 20 different things all up that I looked at, but these are sort of the best 10 or 11 that were proven systems so far over the data that were collected from January to October. Okay, so the goals of these systems were to create something that decreases drawdown. Okay, so we were looking at losing streaks, and I got some really good data on that. Increase expectancy, so taking a basic system and then doing something to increase the expectancy or the average win per trade, and then also, of course, increased return on investment. So that means taking into account not just expectancy but frequency. So you times expectancy and frequency by each other. That's what gives you your return on investment. So expectancy to me is important, but what's also important is how often you get your trading opportunities, and that's what will give you your return on investment. So they're sort of the three main areas that you really need to get a tick for all three of those areas to be classified as quite a decent system. From that data we just looked at, so the best system bases, so those 5 different sort of entries, what worked quite well and what gave the most opportunity to be worked with was the first PowerPoint, and also I want to get a bit more specific with the exits as well. So the first PowerPoint with a fixed profit target, and also the trailing profit target worked quite well as well. So it had some opportunities there, and then the second power fade with a trailing profit target. So there's sort of 3 bases or 3 systems that work well as a base. And then just sliding along a bit here, indicators used. So I'll go through these. I'm going to have a daily range indicator. So obviously that's telling us, and the objective of this range indicator when I go through it is sort of differentiating the different markets between slow, medium, fast markets. Okay, I want to apply different systems to different markets based on what type of range the market's having. So that's the first indicator we'll look at. The next indicator is market movement overnight or while the market's closed, so the gap. So the gap actually tells you a little bit about different systems react different ways to gap movements overnight. Some systems work well with a bigger gap, and some systems work better with a smaller gap, but they've got their reasons for that, so we'll go through that as well. And then combining systems for efficiency. So you start to add all these indicators and you start to blend systems together, and by combining a few things, like if all you did was take some basic symbols and blend the two together, that can start to decrease your drawdown effect, because you're sort of getting a broader hit at the market. Or there's just some simple things as far as combining things to some more advanced combinations that are going to create more efficient systems. Okay, so that's the basis of what we're going to do. Then as far as these systems here, I won't go into them yet, but just to sort of outline it for you, you can see the ones in orange. So the ones in orange are the 3 basic systems I talked about. So the first PowerPoint with just an 8-tick profit, the first PowerPoint with just a 15-tick profit, and then down here the second power fade with a 4-point trailing stop. So I've got those there, how they worked out. They're basic systems, but then what I've done then is taken them and added some of these indicators, in regards to these goals, and made better systems out of them. Okay, and then so there's 1, 2, 3, 4, 5, and then 6, 7, 8. So there's 8 systems created that were better. So from 3 foundational systems, another 8 systems were actually created that would have done a lot better. And then of those 8, I've picked sort of the better ones so that you can see them highlighted in blue. This top 2 here and these 3 here, we're actually going to look at them in regards to drawdown, and because this is me personally. Obviously, a lot of my personal reflection comes into this, but personally, one of my biggest goals is to decrease drawdown. So I've really taken that on board and go, okay, now I've created these systems, I've got better expectancy, better return on investment. How can I decrease drawdown? So I did a heap of study or research in regards to that, and then these 5 systems were the ones that came out really quite well, and I've got a heap of data reflecting a lot about drawdown, which we'll go through as well. Depending on how we're going for time as to whether we get to the drawdown part, that might be next week. I'll see. I'm not sure how long it's going to go for. I don't want to really talk for more than 40 minutes because otherwise it starts to get a bit hectic. So I'll let it go for, say, 40. If we hit 40 minutes and we've still got a fair way to go, we'll talk about it next week. But hopefully we'll fit it all in tonight. ADR is, Kath is, where'd you see that? That's average daily range. Is that written somewhere here, is it? Yeah, so ADR stands for average daily range. It's an indicator that I've created. I just needed something to call it, so I called it the ADR indicator. So yeah, that's what I might do next actually. So before we come and I'll explain a little about these systems. I'll look at a couple of the indicators, and that's from back over here talking about indicators used. There's a couple of things I have to sort of outline for you so you understand a little bit more about this system. And that's how the range indicator works, how the gap indicator works, and then as far as combining systems, well, there's no actual indicator there. That's just a method that I've used to create better systems. But technically, that's a type of indicator as well when you're applying it to create better data or better information. So the first thing, ADR, or average daily range, which we touched on last week. We'll talk about that now. Okay, so as far as average daily range and the gap indicator, you saw all that information before as far as each entry and each exit, based on purely just how they went. Then I went and gathered data in regards, and that's what this all is here, not that it means too much, and there's all sorts of colors, just let the projection catch up. There's all sorts of colors and different things, but basically just looked at, you can see over here, open, close, high, low. From that you can add Excel formulas and work out at a click of a button what was last night's gap. And for example, here we go, here's all the gaps in this red column here. Then you can work out the range, average range of each day. Okay, and then what I did is all sorts of different combinations as far as working out the average range over the last 3 days, 5 days, 10 days, 20 days, 50 days. I did a whole heap of combinations. I've just got some of the data here, but I wanted to get a kind of a broad spectrum. So if you imagine, for example, here's the range. Okay, if you follow my cursor here, I've just taken basically the high from the low. I don't care whether it's a negative or a plus. I just care what the range is. Okay, so that gives the range of the high or the low of the day. So it gives it a rough sort of overview of how much that market moved. Okay, but if you took each individual day, obviously that's not going to be very beneficial because one day, here we go, here's 18 range of 18, the next day 6. That's a massive difference there. So there's no way to be able to use that data. But if you start to create an average of them, a bit like, and you all know how a moving average works, it's the same sort of scenario. If you take a moving average 20, for example, all it does is add the last 20 bars up, divides it by 20 and plots that point there, and what you do is you get a line that tells you where the market's going. And moving average 20, even though the last candle might be lower than the previous one, the last 20 are actually higher, so what that tells you is the market's going up. So the same sort of theory applies for an average daily range. Okay, so then it's just a matter of finding what works best. So for example, if I go add these 3 together, divide by 3, that's going to give my average daily range over 3 days. With Excel, that's the great thing about Excel, you can just drag that and it works out for you every single day, and all of a sudden you've got this daily average range over the last 3 days. Does that, just before I move on, does that make sense how I'm getting that? Can you guys see that? Okay, so yeah, so Kath, it's the high and the low of the cash market. So what I did is, yeah, I've got pre-market data as well. I didn't find a use for it. So what I've got here is as for the ADR, or the average daily range, yeah, just the high and the low of each cash market day. Okay, so that's what this is. You minus the low from the high, and it gives you a range. Okay, not confused now. Great, cool, worked it out. Excellent. So then, as far as working out the average for them, you've got to find one that works best. Okay, so what I've found is through the data is an average three range. So meaning take the sort of average of 3 days. What it does is it's not quite enough. You can still, if you look through the data here in that column, there's still quite a variance between, and you're going to get this line if you plot it. Okay, and the best way to plot it on a graph, and that's what these graphs over here are, and you'll see quite quickly as to whether it's usable. An average daily range using an average of 3 days, it's too small. So it's 5. 10 is actually what I'm using for myself. I found it to be, when I go ahead and test on a whole heap of things, 10 worked really well. It was just that nice balance between sort of being able to let each day influence it, but with the same time enough data, enough of an average to sort of get quite a smoothed out line, something that works. Yeah, that's right, you add it. So for example, if I click here, what that is, I don't know if you can see up here, what it is, it's the sum of the last 20 days. So what I do is I go equals the sum of the last, 10 days, yep, and divide it by 10. And what that gives you, that figure there, is if you take the range of the last 10 days and divide it by 10, it says that the average range was 10.4. Okay, and then if you just drag that formula down, you don't have to do it for every single box. You can then all of a sudden get this formula that tells you what each day as we move forward, because obviously then you go to the next day. So what that is, you just add the next day's range in, and you minus the day from 10 days ago or 11 days ago. It's all done quite automatically. I won't get bogged down with the finer details. If anyone wants to know more about how to do that, or sort of wants a bit of help with Excel and things, I'm more than happy to help you guys with that. But we won't worry about that tonight. But yeah, it's all very easily done in Excel, Kath, if you ever need help with it. And then so I went on and did an average 20, 50, all sorts of things, and found that those sort of things, you got just too much of a flat line. Okay, it's the same as a moving average when you apply it to put it to your charts. Okay, when you're trading intradaily, you can start to get an average that's too big, and you find that line's going to be very flat. If you apply a moving average 50 line to the data, you have quite a flat line. It's not very usable. Okay, so and then you come over here. Again, through Excel, you can just simply grab all that data, put it into a spreadsheet, and what it does, it spits out this range of the last, so you can see down the bottom here, January through to October. Up the side here is 5, 10, 15, 20, so that's the range. So you can see, if you remember through the beginning of the year, and you can see it working quite well, at the beginning of the year, the range is hanging around that 10 mark. It then jumps up as we move into May, June, July. So remember the market used to build up, then all of a sudden it dropped off. It started dropping off through August. Remember the US went on holidays, so because of all that, it really dropped almost its lowest range for the year, because all the US is on holidays. Now we've seen the market now gradually start to pick up more and more as we move along. So if you remember what this year is like, you can see this graph does a really good job at telling you what the average daily range is. Okay, so that's the average daily range indicator. As far as how you use it then, again, it's a lot of trial and error. And finding something, and I'll sort of come back to it as to what's a good point on this graph where we can use it. If the market's below 10, we do something. If it's above 10, do we do something? It's like, no, that's a bit too low. There's nothing much there. But around this 14, 15, 16 area, you can see right through the middle of it there. That's where I thought, there's definitely something there to be able to use. And it's just a matter of testing all those areas and finding something that works. But we'll go through some actual data as to what happened there. Okay, and then the same thing for the gap. So again, taking sort of the gap and taking an average of it. Now, when I worked with the average, I wasn't so sure that an average gap would work. It sort of doesn't apply itself the same way as an average daily range. So I didn't, even though I created some average gap indicators, they weren't really usable. There was nothing sort of really for me to gain from that. But individually, each day, it is quite usable. So certain things or certain systems, if you plug in a formula that says only take this trade if the gaps from the previous night is above 7 or below 5, or work out something, and you test all that, it works. It works quite well, and there's some information there that can definitely be used. Again, it's just thinking about something that sort of can be quite dynamic. So hopefully you guys can start to see now that's a dynamic indicator, but it's quite automatic. If I say I'm only going to take a certain trade if the gap's above 7, that's very automatic, as in I don't have to make a decision as to trade or not trade. It's very black and white for me, but it's quite dynamic in the fact that, well, based on what the market does, I'm going to take a trade or not take a trade because I've got that indicator. So that's what I'm trying to make the point of by automatic discretional indicators. But again, I just want to outline how the gap and how the range is going to be used. But how you're best going to understand that is when we go back over here and actually physically plug it into some different systems. So I'll do that now. Okay, so here I've got some data. Again, I don't want to get sort of too bogged down in the finer details because it's going to be it's going to be really hard to understand unless you sort of go through and do it for yourself. And what I'm looking for doesn't necessarily suit you guys down. So that more the purpose of this is to show you how you can take some pretty basic stuff and turn it into quite a sophisticated system. And by no means is complicated or rocket science. A lot of this stuff was quite simple. You just think about how the market works, and it's just a matter of trial and error and applying some things that you believe should work, and then just letting the figures tell you whether it does or doesn't work. So that's what sort of all this information here is. It's going through and running the figures on all sorts of different systems. Okay, so what I've got up here, and just to kind of quickly go through it, you can see a lot of the things too. What I did is I broke it down and worked out with each system what was the points, that was gained from it, what was the expectancy, and what was the frequency. Okay, because some systems I add an indicator, it doesn't necessarily trade every day. So I want to know how many times within that 10-month period it took a trade. Okay, because some systems work really well, but if it only gives you 12 trades for the year, well then frequency is quite low and it's not necessarily going to work that well. So you want to make sure frequency is still up there. Obviously expectancy and points is really important as well. And then looking at drawdown, well, that's sort of a whole another section, which I said we'll talk about at the end. It's got to be dealt with separately. So the first thing was basically just taking, what have I done here? Actually, I'll start down here. Okay, so let me just scroll down here. So the very first thing I did, probably one of the first things I did, was take that daily average range indicator. I want to first of all make it usable, and thought, okay, find a happy medium in the market where once it's over a certain area, I'm looking for certain systems, and then when it's under, looking for different systems. So it's pretty obvious when it's above a certain area in the market's moving a lot more, you can go for bigger profit targets. When it's lower, you might have to keep it tight. So from that, when you're purely just looking at the PowerPoint system, first of all, tested some different areas on that graph. So go, okay, what if every time it's above or below 13, I applied a different system. So for example, and this is the two that worked out best, but behind this there's obviously a lot of work going into what does work the best. But I mean, if I go back first of all, and if you remember from that PowerPoint data, let me find it. Okay, so we're going to look at the PowerPoint system for a start, just to give you a bit of an outline of this. So if you look here, first PowerPoint, okay, you got 8 tick, 10 tick, 12 tick, 15 tick, 24 tick, and a trailing stop. Okay, and here's the overall results at the end here. So you can start to see that they all work quite efficiently, except for 24 tick. It's probably not the best, so I didn't really look at the 24 tick one. You can see straight up it's sort of really dropped off. But the 15 tick, that's certainly one of the better ones, so I definitely want to incorporate that somehow. And then 12, 10, 8 tick, they all worked really quite well. So then it was just a matter of plugging in and working out what figures was going to be best. So we go back to this one here. Okay, so the first thing I did was from that graph, so the average daily range indicator is take all the different systems, all the different profit targets, and run them through and go, okay, if, for example, this one here, if I took 13 ticks on this graph, okay, so you imagine that there's a line here at 13, and go when the average is above 13, I go for a 15 tick profit. When the average is below 13, I go for an 8 tick profit. So hopefully you guys can see what I'm doing there. I'm just saying, okay, when the market's moving more, I go for bigger profits. Okay, and then running all the different sort of scenarios on there, going, okay, is the best level at 13 ticks? So when the average daily range is above or below 13 ticks, or is it 14 ticks, or is it 15 ticks, or is it 16, 17 ticks, and just finding what works best. And from that, what basically came out, long story short, is that the 14 ticks scenario was the best. All these systems did much better. Okay, so what I've got, these percentages here, you can see in 58%, 75%, 61%, 4%, 15%, 6%. They're saying that if you took this combination, you would have done this much better than just taking the basic system. Okay, but then of all those different scenarios, the 14 ticks worked the best. Okay, it was the best one. So from that, I decided that 14 was that line on that graph that I want to use. So when the average daily range is above 14 or below 14, that's what I want to use as my exit target. So when it's above 14, I take a 15 tick stop or profit, and when it's below 14, I take an 8 tick profit. Okay, and then basically just ran and to see, before I even run more specific data, all I did was just look at the graph and roughly just highlight. So I've got the two systems here side by side. So here's the 8 tick system, here's the 15 tick system. But then I looked at the graph and basically highlighted what I would have done each month based on that average daily range indicator. And straight up you can see an almost immediate spike in the results and a drop in the drawdown. And sort of this is what's happened here. You can see the three systems. So this is if you take 8 ticks only, this is 15 ticks only, or this is you take the blend, so let the average daily range indicator tell you which one you should take. And you can see total points, the blend is definitely the best, expectancy is definitely the best, and drawdown, as far as which months, how many profitable months it had, well, it also the best, as in it had 8 out of 10 profitable months. So it just kept getting better and better. So then it was a matter of just taking that information. Don't actually ignore that one for a sec. Something else. But just taking it and actually putting it in specifically. So going, okay, day by day, if the average daily range, and you can get that easily through Excel. It's not a discretional thing by any matter. It's just, okay, what's the average daily range? And is it above 14 or if it's below 14? And depending on that, day by day, is whether I take a 15 tick profit or an 8 tick profit. Okay, and that could change day by day. You're going to have runs where you stay above 14 and runs where you're below 14, but it could change day by day. And then from that, it did even better again. It got up round to 70 points, and 9 out of the 10 months were actually profitable. Only 1 month in January was in the negative, so it made quite a difference. So just as far as taking some information, applying the daily range indicator, does that make sense? You guys, a lot of sort of going back and forwards there, but are you sort of half picking up what I'm putting down? Yeah. Okay, so that, I mean, and you can, of course, you can apply that to that. That's probably the easiest one to see. You can then apply that, and what I've done up here is done that with, okay, I've taken, well, let's look at the second power fade or the first power point and go, well, let's say if it was above 14, we go for a trailing stop, because we've got a big ranging market, and if it's below 14, let's go for a fixed 8 tick stop. Okay, so just run all sorts of different scenarios. So you can imagine blending different systems, different profit targets based on that, just that average daily range indicator alone. There's a ton of different ways to produce a system. Like, hopefully you guys can see that, and from that there's all sorts of things that worked really well, and there's some things that didn't really add much value, so they sort of dropped. But there's all sorts of things, and that's what all this stuff is. So I'm not going to go through all that stuff now. It's just going to be confusing doing it on tape, but that's sort of the basis of how these systems were created. Okay, as far as the gap indicator, so far, before I get into the gap, so far you can see daily average range or average daily range and blending, how the two of those indicators work. Then the gap indicator, for example, the gap indicator, there's a few things here. I just want to put a few things that didn't work. What I did is said, okay, let's say if the gap's over a certain level, I want to take a power fade, because I thought if the gap's quite decent, the market might just open up and keep going in that direction, and therefore it's going to pick out all the days where the power fade works really well. And I thought even if I just pick something where the market picks up, say 20 days out of the last year for me where a power fade works well, I want to see if that works. And there just wasn't a relationship there. I couldn't get anything. Basically, that first power fade, it just got smashed left, right and center, even when I tried adding indicators to it. At first it showed some signs. I spoke about that last week. But when you ran it through a lot of data, it just didn't work, and that's what sort of this stuff here is. So as far as adding it to a sort of having a system where you just take a power fade every now and then, or you might keep some other systems in place, but on certain days you want to take a power fade because it tells you it that day because of the gap. I tried average daily range when it's over a certain range and over a certain gap, tried all sorts of things, and nothing produced any sort of results that were worth pursuing, so I dropped that quite quickly. But when you came over here and added gap indicators to the first PowerPoint and the second power fade with trailing stops, it actually made quite a difference. For example, where's one? So you can see, like, here's the expectancy column. So those systems, as they are just normal systems from the raw data, their expectancy was round about anywhere from 0.6 to 0.8. Like, it was always quite less than 1 tick. Okay, that's in ticks. If all of a sudden I added the gap indicator, you could see expectancy was really increased in certain areas. So from that you could start to see patterns starting to form for different reasons. So that's how I started to apply the gap indicator. Okay, so then here's all sorts of different systems. Okay, so here it is here. Let the projection catch up. So you guys sort of, now you should understand how we've come to this point where we're going to start creating some systems. Okay, so you understand what the goals are, what the basis of this information is, and the indicators used. Now from that, remembering the first PowerPoint, just an 8 tick profit or just a 15 tick profit, there's the figures on it. Expectancy, frequency, obviously over the 10 months there's 204 trades, it's always going to be the case, and there's the points. Also that second power fade entry with a trailing stop, again there's the expectancy, frequency and average number of points. Okay, and then over here on the far right hand side I've got sort of the qualities of it. So if you look at those basic systems, so the original 8 tick profit system, it's okay, but it's got a very low, compared to other areas, it's got a very low expectancy and return on investment. The first PowerPoint with a 15 tick profit, okay, so what happens there is, yes, expectancy is medium, return on investment is good, that really picks up, but if you go through it and look at drawdown, it's got a really high drawdown. Well, not really high, but it's got a lot higher drawdown than the 8 tick profit system. Okay, so that's a problem. Then looking down here at this next orange one as a basic system, the original system, what's good about it, it's got good fills because it's power fade, but it had the highest drawdown out of all the systems. Okay, you could probably relate to that, Kath. I know that this is something that you originally created and looked at. The idea is there, and over a year it definitely works. But the fact is, it's got actually some really high drawdown periods that, and we'll go through that sort of, there's a whole section on that soon, that can can be quite testing. But there's some simple things you can do to really improve the system and actually eliminate that drawdown and really bring that back into a zone that's quite favourable or that you can handle. So they're the three basic systems. Okay, so then if we do a few things. So the first thing that worked really well was taking the first PowerPoint system, okay, and when it's above an average daily range of 14, having a 15 tick system profit and an 8 tick profit when it's below 14. So we went through that before, and you can see just from that, same frequency, expectancy straight away jumps up, points jumps up as well. So high frequency and actually highest net return is its benefits. The next system was, okay, well, let's take that idea and go first PowerPoint, and when it's above an average daily range of 14, let's just take a 15 tick profit and do that only. And the days where it's below 14, we'll just let it go by the wayside. So what happens there? Expectancy dramatically increased, like massive expectancy. In fact, one of the best expectancies of all the systems. Frequency drops. Obviously, you're applying an indicator where it needs to be over a certain range. So it goes through, 2/3 of the year that system doesn't trade because there's not enough market movement. Who knows what will happen next year? There might be 200 signals, there might be 50 signals. It really depends on how much range. But that indicator will always tell us what's happening. And so that's why it's quite dynamic, but at the same time it's automatic. Okay, so but you can see points still very high, still up near 50 points. Yet it only took 73 trades. So that's why its expectancy is so high. So it really improved expectancy there. The next one, taking the first PowerPoint when the average data range 14 method is above 14 and applying the gap. So you can see actually expectancy increased again. So what happens here is, so that's basically this previous system, just taking the PowerPoint when it's above an average daily range of 14 and just taking a 15 tick profit target and then applying another indicator where, okay, the gap needs to be above 7. Because what it needs is it needs some movement overnight, and what that did is really helped. And so again, expectancy increased, but a downfall is that frequency is obviously starting to drop, and so the return on investment isn't quite as high, even though expectancy is increasing. Okay, so remembering return on investment or your overall points is expectancy times by frequency. So expectancy can go up and up and up, but there's got to be a fine line. There's got to be that balance. Do you want to? If all you do is focus on expectancy, well, you take this one, but because frequency is starting to really drop off, then the return's dropping off as well. So as a trader, every individual is different. Someone might prefer that system. For me, I don't really care about drawdown is my biggest thing. And between these two systems, there's not a lot of difference in drawdown. So I'll take the one with a little bit less expectancy with a higher frequency rate and a higher return on investment. Next one here, first PowerPoint with a trailing stop. Okay, when the average daily range is above 14. So looking for those bigger profit targets, but only in certain markets. So again, you only get 73 days there, and again, you can see an improvement in expectancy than the original system. A big improvement. But overall, I couldn't see a lot of benefits there. There's certainly some better systems, so I wasn't going to focus on that one. And then the first PowerPoint, again with a trailing stop when it's above the average data range of 14, and then a PowerPoint taking when the average data range is below 14, just taking an 8 tick stop. So basically, with that average daily range, when it's below 14, having an 8 tick stop. When it's above 14, actually having a trailing stop. And that worked okay. It wasn't the best. Like return on investment is still pretty high, but expectancy dropped. So the return on investment was staying up high because it took a lot of trades. So it still worked quite well. Overall 49 points, but expectancy started to drop. So for me, I didn't see a lot of value there. Okay. So now we move on to sort of another type, the other systems based on the power fade or the second power fade of the day. So this is your bit of an area, Kath. So if all you did was take it with that trailing stop, like you worked out, expectancy is not too bad at 1. It's got a pretty good return on investment, high frequency, but as you'll see, its real downfall is its drawdown. It's got the worst drawdown out of every system that was calculated. Okay, so a simple way to fix that straight away was a few different things here. If you look at the return on investment or points, you can see a few different things here. This one is a lower points count, but it's got a lot higher frequency expectancy and a lot lower drawdown. Then you can get these next systems, which we'll go through in a sec. You can see that return on investment is higher and a lot lower drawdown. Actually, you can see the drawdown figures in the side here, and I'll show you how I came to these in a sec. But basically, what these percentages, if you want to sort of get a heads up on them, it's looking at what you made for the entire period. So we're looking at the last 10 months, and actually it had a drawdown. So for example, this one here, 62%, it had a drawdown or a losing streak where you lost 62% of what you gained, or 62% of your total 10-month gain. So if this system gained 55 points, 62% of 55, that's about 35. It had a losing streak of 35 points, which is way too high for me. You can see some of these other ones really low, like this one up here had a really low losing streak. Oh, there's the points there I didn't even see. So you can see most of them are around that 9, 10, 15 mark, whereas this one more than double. It was up over 33 points as far as the losing streak. Okay, so then if you take the second power fade with a trailing stop and just take it when it's above that average daily range of 14. So obviously frequency drops, expectancy really increases, drawdown drops, which is great, return on investment not too bad. The next, I think this is one of the better ones of it all, is when you take the second power fade with a trailing stop when it's above an average daily range of 14, but you take the power point every other day when it's below the average daily range of 14. So you keep on taking the trade. So what that does, it ups your frequency. Expectancy is not quite as high, but return on investment goes through the roof with a low drawdown. Okay, so there we go. There's a blend of some systems. You add a simple indicator, an average daily range indicator, and return on investment and drawdown, which is my two biggest goals, both improve dramatically. And then second power fade with a trailing stop, and only take it when a gap is below 5. So basically what I found is when there's a shorter gap overnight, so a small gap, it's got more chance of trending the next day. That's what I found. So that's why this works well when the gap's under 5, because what happens is there's no movement in the pre-market. It's waiting for the cash market to move. Okay, so picking up trends works well when you've got a small gap, so I look for small gaps. So when the gap's less than 5 and you apply the trailing stop, it actually worked really well and got really good, one of the best expectancies. And that's like this one up here with the first PowerPoint. When the gap's above 7, I'm just up here for a sec. PowerPoints actually work better when you've got bigger gaps, because what happens is the market goes into, when you've got a big gap during pre-market, market opens up and goes into a range. So it's more likely to bounce between PowerPoints. So therefore, big gaps work with PowerPoints, small gaps work well with trends. Okay, that's sort of the basis of what that gap research and indicators found. So yeah, and that's sort of, then you can see from that how the indicators and combining and putting it all together, you can start to then work out what works for you, and what's your objectives, what's your goals, and so based on that, you'll find what's going to work more in your favor. So just before we move on, so drawdown, when we're talking about drawdown here, which we'll actually look at now, drawdown doesn't affect the actual result, okay? But what does really matter is, and when you read these books, sort of Trading in the Zone and Trade Your Way to Financial Freedom, and sort of if you'd sat down and talk with any sort of big professional trader, they'd tell you that one of your number one goals should be looking at drawdown and how that affects your system. And I learned to, a couple of years ago, really focus on drawdown, and it became, I never knew about it for probably a year of my trading career, and then all of a sudden I learned about it, and it's my, I've said it many times, it's my biggest focus in trading now. So definitely want to apply it and see how it affects the system. And so like I said, this one here is the biggest drawdown. Like having something where you have a losing streak of 62% of what you make, that's just big, and it's and there's 2 points to make here: is can you handle it? One is many traders could. There's no problems if you can handle it. It's not an issue. But imagine if you didn't work out drawdown. Imagine if you're going through. Excuse me. Imagine, sorry. Imagine if you're going through it, and yeah, you know all about it, Kath. It's you've been through the winning streaks and the losing streaks. Imagine if you're going through it, and yeah, you've got a winning system. You've got something that's going to produce you 55 points, but you start hitting this losing streak, and you might not have your contracts or your position sizing worked out correctly, or you know you can't handle the losing streak because you weren't aware it's coming, and then all of a sudden you bomb out of it. You leave this perfectly well functioning system behind. Yet all you had to do is, well, one is either do something to eliminate that drawdown, or two is just take it on board and realize that it's a fact and it's part of the system. It's a part of what makes you money, and dealing with it before it happens. It makes sense. Trailing stop, Eric. Yep. Go through that again. So trailing stop is basically, again, it's a dynamic stop rather than a static stop. So as you know, the fixed stop is just, okay, if it goes 8 ticks, it's just set, they're ready to go. I just want 8 tick profit, 15 tick profit, whatever. A trailing stop is where it lags behind. So if the market takes off, I used a 4-point trailing stop. Okay, so and I got that idea from you, Kat, which is a good one. And basically, as the market moves, it just keeps on going. You'll never get stopped out. It's got potential to go forever. And what happens is that stop is 4 points behind the previous highest point of the market, or of your trade. Okay, so on the downside or the upside. So you imagine the market goes up. Okay, it pulls back 2 points and then goes up again. It hasn't pulled back enough to stop you out. Basically, as long as the market doesn't pull back more than 4 points, and the market just keeps on going, on the downside, upside, whichever way you're in, you could keep on going forever. So what it does, it gives you an opportunity for that to take a lot of profit on the days that trend really well. And yeah, Kathy did some great work with finding out what works best there. This is just an example of this sort of stuff. You took it and said, okay, is it best to have a 2-point trailing stop, a 3-point trailing stop, a 4-point trailing stop, or a 5-point? What's the best scenario? And again, you just run the figures on all the information, and you find what works best. Does that make sense, Eric? Or if you don't quite haven't got a picture of it yet, that's fine. Just let me know, and I can bring up some charts. Just let me know. Make sense? Okay, cool. It can be, and then of course, you've got to work out when do you go to break even, when does the 4-point trail kick in. Because there's many times the market will go 4.5 points. You got a 4-point trailing stop, comes all the way back, stops you out for half a point because you're trailing by 4 points. Well, then there's a 4.5-point move, and you only got half a point out of it. Okay, so it definitely has its ups and downs. It's something that you've got to really look closely at and find what works best. And when do you go to break even and all those sort of things. You've got to give it enough room to be able to go, but at the same time, you don't want to give it too much room where you're giving away a lot of profits. That's the balance of any exit target. And again, it's just running the data and finding what does work. But anyway, so guys, what I'll do is, we've been going on talking for quite a while now. We're nearly hit that hour mark as well. So not that it really matters, but I think I'd rather do this sort of the last part, drawdown next week, and sort of come at it fresh again. We'll kind of wrap up what we spoke about again. Have a think about it. Ask any what I've said. I've taped it, so if you want, you can go back over it. I know we'll bit stop and start at sections, just trying to get sort of the main points across, but just let it all sink in. Think about it, how you would apply it, if you would apply it. And then next week, quickly go over some points again. We'll take any questions, if there is any, and just look at drawdown fresh next week, because it's a very important part, and I want to show you a few things that I did with it, and how you can really get a really good understanding of drawdown. So it's best to really take 15-20 minutes and look at that properly, and while we're back and fresh. Okay, so we'll leave it at that, and we'll talk about drawdown next week. Thanks, guys.